having the nice cars, having the nice watches, having the nice home. That's looking rich. You can look rich and be broke. If you keep growing it and you don't take out any money for yourself, there's a chance that things don't work out. You're gonna own a car that's really worth nothing because your cars aren't worth anything. What's up, everybody? I am Jasprit Singh from theminority-mindset.com, where money minds rethink rich. The thing that makes most wealthy people wealthy and what keeps wealthy people wealthy is financial education. Now, I know, yes, some people got there by luck. Some people had rich parents, some people won the lottery, but the majority of people got there through the right financial education and by knowing what to do with their money. And in this video, I'll put together some of our best clips that way you know how to manage your money like wealthy people do. Let's get into it. I grew up in a traditional Indian household. My parents are immigrants from a state in India called Punjab, and they're some of the hardest working people that I know. But since I was a kid, they always taught me the importance of working hard, being honest, and becoming successful. Now, I don't know how it is for you, but in any Indian house, the definition of success is very simple. It comes down to a very simple equation. Success equals being a doctor. If you become a doctor, you are by default successful. If you go out and you ask any Indian mom out there, the solution to becoming successful at anything is by becoming a doctor. If you want to make a lot of money, be a doctor. If you want to be happy, be a doctor. If you want to be healthy, be a doctor. If you want to get married, be a doctor. But now, if we dive a little bit deeper and we define what the success is as financial success, now things look a little bit different. Now, I know there's a lot of different definitions of success out there. Being happy, having a good family, being physically healthy, being mentally healthy, having a purpose. But for the purpose of this video, I'm going to be talking about financial success. So now, if the goal is to become financially successful or wealthy or rich or whatever you want to call it, if the goal is to become financially successful, is the solution to become a doctor? Well, becoming a doctor teaches you how to diagnose a sick person, how to take care of a sick person, how to do a lot of things. If I was sick, I would pay a doctor a lot of money to treat me. But being a doctor doesn't necessarily mean that you're going to be financially successful. Being a doctor means you are qualified to treat other people. At this point, every Indian mom watching this video is saying,
"Oh, Jasprit's just saying that because he's not smart enough to be a doctor."
And yeah, that might be the case. But if you want financial success, the solution is to be financially educated. Because if you're financially educated, then you have the resources and the knowledge to use your money to become financially successful. This is how the majority of people, probably something like 90% of the population, manage their money. First, you make money from your job. You get a paycheck. This could be $20,000 a year or $2 million a year. It doesn't matter how much money you make. You make money from your job, and the first thing you do is you put this money in your bank account, and then you start spending this money. So you got your home expenses, you got to pay for your car, you got to go buy some clothes, you go on a vacation, you spend some money, and then that's why I got this dotted line here. If there's any money left over, you save this money. Now, some of you might be better than others at saving. You might not spend too much money, that way you can save more money, but for the majority of people, this is how their finances look. You make money, then you spend a lot of it, and if there's anything left over, some of that money gets saved. If you're wondering, "Oh, Jasprit, how do you know how people manage their money?" Well, just look at the numbers. 1 in 5 Americans do not have $5,000 saved up for retirement, and 7 out of 10 Americans, the majority of Americans, don't have $1,000 in cash saved up to protect them from an emergency. What the minority of people do is they start by smashing that thumbs up button below, because the way the YouTube algorithm works, if you do not smash that thumbs up button, then YouTube is much less likely to show you and other people our financial news and education videos. So if you hit that button, I will very much appreciate it. But what the minority of people do is first, they get paid. So let's assume for this example that you're getting paid from a paycheck again. Now I'm gonna go right to left this time. This time they start by saving money. So you put some money aside for your savings first. And then you invest some money. So you put some money aside, then you put some money to work for you. And after you save and after you invest, that's when you spend. So it's a different order of events. The difference here is the majority of people make money, they spend their money, and then if there's any money left, that's when they save it and that's when they invest it. Wealthy people, the 1%, what they do is you make money and then you save it and you invest it first, and then you only spend what's left after saving and investing, because investing and saving is going to build your wealth. Investing is going to build your wealth even more. Saving is just really protecting your wealth, but you need to do these two things first. That way you can build your wealth. The simplest way to do this is to create a financial system. One of the things you can do is to follow our 75, 15-10 plan. What that means is for every dollar you earn here, so you make $1 from your paycheck or your business or however you make your money, every time you make a dollar, it's gonna flow down in this way. Out of this dollar, 75 cents is the maximum you can spend, 15 cents is the minimum you should invest, and 10 cents is the minimum you should save. When you do this, now you're investing and saving your money and building your wealth first before you spend your money. Now, if you're younger and you don't have a ton of financial responsibilities, then this is your time to build. What you should be doing is following our 50-30-20 plan. That means now you're spending less money, you're only spending 50 cents out of every dollar you earn, but you're investing 30 cents and you're saving 20 cents because now this is your opportunity to build. If you don't have a ton of expenses, then invest and save more aggressively now. That way you can build the foundation for your financial wealth. This is where a lot of people put up a smokescreen. They say, oh, you shouldn't worry about money like that. Money doesn't matter. You should just work on being happy. And yeah, you need to be happy, but money is a tool, okay? If you are a good person, money will give you a tool to do more good. If you are a bad person, then money gives you a tool to do more bad. The size of your paycheck matters, but it's not going to determine whether you're going to become wealthy or not. It's what you do with the money you make. Because if you make $200,000 a year and now you're spending $200,000 or you're spending $220,000 with credit cards and loans, well, you're broke. But if you make $30,000 a year and you're saving 10% and you're saving 15%, you are setting yourself up for wealth. But now, in order to build that financial foundation, there's 5 other things that I need you to do. I'm going to be talking about these 5 things. First, you got to track your money. You got to know where every dollar you're earning is going. Then you need to build a financial shield to protect yourself. Then you gotta stop bleeding cash. Then you gotta put your money to work. That way your money can make you money. And then you gotta put fuel on the fire to amplify the system. That way you can build your wealth even faster. First, you gotta know where your money's going. Because if you don't know where your money's going, then it is going to disappear. So you need to track how much money you're making and where your money is going. How much money you're spending, where you're spending it, how much you're investing, and how much you're saving. You need to have a track of all of your money, and this is something that you need to do every month. Even if you're not a financial person, you don't like talking about money, this doesn't have to be too hard. There's a ton of free apps out there that you can use to help track your money and help monitor your money. I'm kind of old school. I just use an Excel sheet. I've kind of built my own pro forma and my own kind of system where in the beginning of every month, I write down on my Excel sheet how much money I made and where all my money went, because if you don't know where your money is going, it is going to disappear. In the business world, what we say is if you can't track it, you can't optimize it, because if you don't know how well a system's running, you can't improve that system. Well, it's the exact same with your money. If you don't know where all your money is going, you can't improve where your money is going. You can't improve your wealth because you have nowhere to see how your money is being spent. Once you start writing down where your money is going, the second thing you need to do is build a financial shield, because you need savings. Right now, the vast majority of Americans don't have $1,000 saved up, but the reality is sometimes life happens and emergencies happen and you need cash to cover that emergency, because if you don't have cash, then now you got to go into credit card debt, which is very expensive, or you got to get a payday loan, or you got to get a hard money loan. And in all of these situations, you are getting skinned alive by the lender, and I don't want you to do that, which is why you need to start saving some cash. That way you have a financial shield to protect you from emergencies. In general, your goal should be to save something like 3 to 6 months worth of expenses in your savings account. Now, this savings money is not money that you're going to use for a down payment on a house. It's not money that you're going to use to go buy a nice car. It's not money you're going to use to buy a new cell phone. This money is just sitting there to protect you from an emergency. That way you don't have to go into credit card debt when an emergency happens. So this should be your base goal, 3 to 6 months worth of savings. But if you really want to protect yourself and you want to be really risk adverse, then you should have something like 12 months worth of expenses saved. You don't really want to have too much more than that, because saving money is losing money. Your savings accounts are not paying that much in interest, yet at the same time, inflation is 2 or 3% a year. What that means is the price of things, the price of living is going up by 2 or 3% a year, while your savings are just sitting there flat. So if your savings aren't growing, but the price of everything else around you keeps going up by 2 or 3% a year, that means your savings are essentially losing value each and every day, which is why, yeah, you need savings to protect you. But you don't want to save all your cash, because your goal should be to build your wealth, and I'm going to talk about that in just a second. If you're subscribed to our YouTube channel, you know that I love using my credit card to make transactions, because anytime I use a credit card, I get cash back, I get points, and I never carry any interest because I pay off my entire credit card balance in full every single month. That way I get the perks and the rewards from the credit card company, and I don't pay them any additional money in interest. But a lot of people right now are getting skinned alive by the credit card companies because they're spending money on extra guac that they can't afford, and now you're having to pay 15, 16, 17, 18% interest on that extra guac, which is skinning you alive. And so what you need to do right now is stop bleeding cash. You know, it's always kind of funny to think about this because we talk a lot about investing on a YouTube channel, and I'll talk about, okay, if you get a 7% return on your money, this is what will happen, or if you get a 10% return on your money, this is what will happen. And every single time I do that, people will leave comments saying things like, or where am I supposed to get a consistent 10% return? But at the same time, do you want to know somebody who is getting a consistent 19% return every single year? Your credit card company. And you are the one paying it if you have credit card debt. Let me show you what I mean. So I was reading on a NerdWallet article that many Americans are taking more than 10 years to pay off their credit card debt. So if your credit card company is charging you 19% a year, what would happen if you invested that money and got a 19% return on your money? If you could invest $1,000 a month, and let's say you can get a 19% return on your money every single year. Now, I know it's not very easy to get a 19% return every single year, but your credit card company is doing it. So if you invest $1,000 a month and you can get a 19% return on your money every single year, and you do this for 10 years, which is what a lot of people are taking to pay off their credit card debt, this $1,000 a month investment would grow to over $420,000 over those 10 years if you could get the same 19% return on your money. Well, your credit card is getting that 19% return on your money, and so your credit card is becoming wealthy because of you while you are staying broke. So what you need to do right now is you need to stop bleeding cash because you need to pay off your credit card debt as fast as possible. Credit cards are a tool. If you know how to use them and you know how to use your money, you can get a bunch of free perks, you can get a bunch of cash back for doing nothing except making your regular transactions with a credit card. If you don't know how to use a credit card, then you are being skinned alive by a credit card company, and you need to stop bleeding cash and you need to get rid of your credit card until you can figure out how to control your spending. And right now, you need to get out of credit card debt as fast as possible. That means cut your expenses, work harder at your job, get a raise, do whatever you gotta do, find some extra cash and put it towards your credit card debt because you gotta stop bleeding cash as fast as possible because this is eating away at your wealth. Once you get here to number 4, this is where things get really fun because now you're putting money to work. You can only work 10, 12, 14, maybe 16 hours a day consistently. I mean, yeah, maybe some days you can work 20, 22 hours a day, but you can't do that consistently, okay? You're gonna get burned out. But your money doesn't need sleep. Your money doesn't need to go to the bathroom. Your money doesn't need a vacation. Your money can work for you 24 hours a day, 7 days a week, including holidays, which is why once you got this extra cash, you need to put it to work. That way your money can earn you more money because you need your money working for you while you're sleeping. This is what investing is all about. You're sending your money out, that way your money can attract you more money. Lots of people assume that putting your money to work and investing means that you have to throw your money in the stock market, but that's not the only way that you can invest your money, and it depends on what your risk tolerance is. One of the simplest and easiest and the least risky ways to invest your money is just by paying down your debt. If you have student loans that are costing you 6% a year in interest, and you pay it off a year early, well, now you just got a 6% guaranteed return on your money for that year, because now you don't have to pay 6% in interest to the bank or your lender. That 6% is what you get to keep in your pocket because you paid off your student loans a year earlier. This doesn't have really any risk because if you pay down your debt early, that's interest that you don't have to pay. You should also be investing in yourself and your own mind because like everybody says, you are your own best investment. If you know how to use your money better, you can use your money better and get a better return on your money. Now, this takes time and it takes money, but this can be one of the most valuable things that you do because if you don't know how to invest your money, then you're not going to be able to get the best returns. So this could mean reading books, it could mean taking classes online, it could mean going to seminars, whatever it is. You need to be investing in your education, especially your financial education, if you want to know how to use your money the right way. That way you can get the best returns on your money. The other kind of education is financial tuition, and financial tuition is when you lose money by making a bad investment. I'm a real estate investor and I have read a ton of books on real estate investing, but some of the best real estate investing knowledge I got was by investing in a property, which I call my nightmare property, where I lost a ton of money. It was my education. It was the financial tuition I had to pay to learn how to be a good real estate investor, because there's just some things that you can't learn in books. There's just some things that you can't learn in courses. So that's another kind of education where you just go out and do things because there will be times when you lose money. That's just reality. By the way, if you do want to learn more about my worst real estate deal ever, it was a nightmare property.
I read a lot of books that say, every real estate investor has one really bad deal. This is mine. So I want you guys to learn from my mistakes. This is not something to teach you in business books or even something to talk about in real estate books. So I want you guys to learn from my mistakes so you don't make the same mistakes as I did, because it was very expensive. Let's take a look inside.
I walked through that deal on YouTube, and if you want to watch that video, I will also link it for you in the description below. Then you have investing in assets. This is your more traditional type of investing, because now we're talking about investing in the stock market or investing in real estate. Now you're really just putting your money to work. That way your money can attract you more money. The way it works is now you're buying an asset, you're buying an investment for the purpose of making money, because you're buying something that you think will go up in value. So if you buy a stock for $100 a share, and then this company starts to make more money and the value of your stock goes to $200 a share, now you just doubled your money. You can also put your money to work for passive income, because now certain stocks pay dividends. What dividends are cash payments. Is passive income that you get just for owning a stock that pays a dividend. It's the same with real estate. If you buy a home, you can rent out this home for $1,000 a month, and now every single month your tenants are going to pay you $1,000 a month for living in your property. And now even if you're sitting on a beach somewhere, you're still getting $1,000 a month every single month from your tenants that are living in your property, and you don't have to do any of the work because you put your money to work. You use your money to buy an asset, to buy this house, and now your money through this asset is generating you passive income. And the best part of all is now you're creating a new income stream that you're earning without having to physically go to work. Because now if you have income coming in from your stocks, or if you have income coming in from your real estate, this is money that you're getting without you going to your job. Now let me give you a quick disclaimer here, because there's a lot of kind of misconceptions out there about passive income and investing, with a lot of people on the internet saying, oh, you can become a millionaire overnight by just throwing your money in stocks or by throwing your money in real estate. Well, it doesn't really work like that. It is a slow, gradual wealth building process where the more money you put in, the better returns you will generally see, and the more time you have, the more money you will make. Now, before we get into number 5, I do want to let you know where you can learn more about investing, because our team puts out tons of articles on how to invest your money and build wealth through stocks and real estate on our website, theminoritymindset.com. And I'll also link an article for you up here and in the description below. And that's when we come to number 5, putting fuel on the fire, where now you understand how to use your money, and now it's time to earn more money because you know how to grow your money even bigger. The reason I talk about this now, not earlier, is because a lot of people think that the solution to their money problems is just earning more money. But there's a little problem with that. If you don't know how to manage your money with $40,000 a year, you're not going to know how to manage your money suddenly at $400,000 a year, or even $4 million a year. That's why 70% of lottery winners become broke or bankrupt within just 5 years of winning the lottery. And that's why 78% of NFL players who make a ton of money while they're playing in the NFL end up broke or bankrupt within just 2 years of retiring from the NFL. Making more money does you no good unless you know how to use your money first. That's why once you know how to use your money, it's all about putting fuel on the fire, because now you have a financial system. You've built your savings cushion. You're no longer bleeding cash, and now you're putting your money to work. Once you do that, it's all about amplifying the system by earning more money and putting fuel on the fire. The way you do this is going to depend on you. For some of you, that might mean asking for a raise or working to get a promotion, something where you can get more money from your job. For others of you, maybe you're working a job, but you also really like baking cakes. If that's the case, now you can start a side hustle where on the weekends, you're baking cakes and you're selling it to your friends and your neighbors and other people that like your cake. And for others of you, you might have an entrepreneurial bug where you just really want to start a business. The whole purpose here is now when you make more money, you don't just go out and buy a fancy car. You follow your financial system. You're going 75, 15, 10, or you're going 50, 30, 20. Whenever you make more money, you're just taking that money and you're putting it into your funnel. That way you're investing more money, you're saving more money until you have the savings cushion built up, and then you're spending a little bit more money. The whole purpose of all of this is to manage your money in a way where you're paying yourself and you're building your wealth first before you go out and spend all your money and make all of those companies around you rich. Before we get into the next clip, I want to let you know that if you are interested in money management and investing, our team put together an amazing guide that you can download for free that walks you through how to manage your money the right way and how to invest your money and how you can build your wealth over the long term. So if you want to download this guide and start learning how you can be better with your money and how you can start investing for wealth, you can download this guide for free when you subscribe to our daily newsletter. And I got the link to how you can download this guide in the description below. There are 5 ways for you to generate cash flow. You have to use your money to buy one of these 5 things. Number 1 is to generate interest cash flow. The way it works is you take your money and now you lend this out to someone else. So you take $1,000, you lend it out to your cousin Bunty. Now your cousin Bunty goes to his favorite store, Gucci probably, and now he's gonna go buy himself a new wardrobe and he's gonna pay you interest on the $1,000 that he borrowed from you. Number 2 is royalty cash flow. Royalties are when you go out and you write a book, and now if this book gets published and it is kind of being read by a lot of people, now you're gonna get royalties every time somebody buys your book. Profit share is now kind of like Shark Tank. You go out and you find a nice company and you give them some of your money. Now this company starts to grow, and every time this company makes a profit and they distribute it to their owners, you get your share of the profit. So if you own 10% of a company and they make $100,000 profit and they distribute this $100,000, you get $10,000 as the profit share distribution. Number 4 is rent. I love talking about real estate investing. This is where you buy a property and every single month a tenant that's living in your property is going to pay you rent for living there. And then number 5 is dividends. This is purely passive. Now you can invest in a company or a fund that is going to pay you cash flow through dividends, usually every quarter. These top 4 are kind of passive. They can be passive, but they require some sort of work. Like with interest, if you want to lend your money out, yeah, you don't have to really do any work after you lend your money out, but it takes a lot of work to find somebody to lend your money out, and you have to qualify them and make sure that you get paid. If you don't get paid, now it's more work on your end. Royalties. If you want to get the royalties from selling a book, you got to write the book first, so it requires work. Profit share. Now, if you want to be a venture capitalist or a shark on Shark Tank like that, it takes a lot of work to analyze the companies, and you got to help them grow, so it requires work. Rental income. Yes, real estate can be a passive investment, but now you got to put in the work to find the property. You got to build a real estate team and you got to do all that work. Dividend cash flow is purely passive. Once you find the right company or the fund that you want to invest in, this money is going to come in and you don't got to do any work, which is why in this video, we're going to be focusing here how you can live a dividend lifestyle, meaning use the cash flow from dividends to fund your life. So that's what we're going to be talking about today. But before I get into that, I need you to do me a quick favor and smash that thumbs up button below. And a quick word from our sponsor, M1 Finance. If you are interested in investing your money, M1 Finance lets you do it automatically and passively. So if you want to learn more and see how you can do it with M1 Finance, I got the link to how you can do that in the description below. So if you want this cash flow from your investments, this passive income to cover your investments, you got to know what it's going to take. And let's assume, for the sake of this example, that you want $40,000 a year to cover your expenses. $40,000 a year is just over $3,300 a month. So you want to make $3,300 a month in cash flow from your investments. Now we've got to figure out how to do that through dividends. Essentially what you got to do is you got to understand the different types of income there are. So there's active income and then there is passive income. What you're going to do is you go to work every single day. And this is the active income that you're earning. This is your earned income. You go to work, you get a paycheck, you want to take some of this money and you want to put it towards your passive income, towards your passive investments, things that are going to pay you with cash flow. In this case, we're talking about dividends. So every time you get paid, you want to put a little bit of your paycheck, the more the better, towards your passive income. And now in this video, I'm going to be going over how and how much to get this $40,000 a year or $3,300 a month. That way now your dividend income can fund your actual lifestyle. The way dividends work, and I'm going to get more into this in just a minute, but you can take your money and you can invest it into a company like McDonald's. Now, McDonald's is a very established company, and every year they have a whole bunch of profit, a bunch of cash sitting in their bank account. Now, when they have this cash in their bank account, there's 3 things they can do with this cash. They can save some of this cash for emergencies, they can put this cash back into their business so they can grow faster, or they can give this cash back to their investors, people like you. So what they do in this case is they say, well, we have so much cash in our bank account that we have no better use for this cash in our own company, so we're just gonna give it away to our shareholders in the form of a dividend. So every year, or actually 3 times a year, McDonald's sends out a check to all the shareholders, people like you, people who own their stock, and this is what a dividend is. So a dividend in this case is every 3 months you get cash deposited into your bank account because McDonald's has paid you a dividend. It's completely passive. You don't have to do any work to flip burgers or any of that. If you own the right shares, now these companies will pay you with this cash flow. The reason why dividend investing can be so attractive to some people is because you don't need a ton of money to start investing in dividend stocks. Like you can start investing in dividend stocks for as little as $100. You can compare that to investing in real estate, where you're not going to buy a property for $100. So if you want to start investing in dividend stocks, start generating this cash flow from dividends, it's a much lower barrier to entry. You can start with $100 a month or whatever money you have, and you can slowly let this compound. And at the same time, if you invest in a strong company, hopefully the stock price will go up. And as the stock price goes up, hopefully the dividends will go up too, because as a company makes more money and their profits grow, they'll be able to send out bigger checks to you. So if you invest in the right companies, you can win in a few different ways, because you'll get bigger cash flow every single year, and the value of your stock, your investment, is also going up. Now, if you really want to understand what it would take to replace your income, in this case, assuming $40,000 a year with dividends, you got to understand what kind of dividends are out there. Now, I do got to give you a little bit of a disclaimer here, because investing has risks. You are never guaranteed to make money when you invest. You might even lose money, so you should always do your own due diligence and never blindly listen to a random guy on YouTube. And everything I'm talking about today are just examples. I'm not telling you what to invest in. I'm just showing you how the process works. So you want to always do your own due diligence, okay? Right now, at the time of me recording this video, McDonald's is paying a 2.3 annual dividend yield. Now, this can change with time, but this is what it is right now. If you wanted to invest money into McDonald's right now and make $40,000 a year in dividend income based off of this dividend rate, you would have to invest $1.7 million in order to get $40,000 a year in passive cash flow through dividends in McDonald's. Now, I know this is going to seem like a lot of money, but I'm going to show you how you can accelerate this. EIX, this is Edison International, the electricity company. They pay out right now, at the time we're recording this video, a 4.5% dividend yield. So if you wanted to get the same $40,000 a year in passive income through EIX, you would have to invest right around $888,000 into this company today based off of this 4.5% yield to generate $40,000 a year passively. If you wanted to do it through IBM, which is right now, at the time of recording this video, paying a 4.8% yield, it's going to cost you $833,000. And AT&T right now is paying a 6.9% yield. And if you wanted to get the $40,000 a year, it will cost you right around $580,000 today. Now, there's a couple things that I want to point out with this. One, this is not something that you have to just do today. If you want to build this cash flow, this dividend income, it's going to take time. And the way you want to do this is by every single month, every time you get paid, you want to put some money towards your investments. And the best way to do that is automatically. That way you don't accidentally forget to do it. But you want to consistently keep investing your money into these stocks or whatever dividend stocks you're looking at if your goal is cash flow, because now what you're doing is every month you're just building up this machine that's paying you. Maybe right now you're only making $5 a month, but over time that's going to grow to $50 a month, then $500 a month. And so you got to understand that this dividend cash flow isn't something that just happens overnight. It's something that takes time. It's something you got to build up. So you got to get into the habit of understanding that every time you get paid, some of this money has got to go into your cash flow producing machine, your dividend stocks that are going to pay you with income. The second thing that I need you to understand is the risk. Because let's just say, for the sake of this example, that you look here at AT&T and you say, AT&T is paying the highest dividend, so I'm going to invest my money only into that company. And so now for the next 10 years, you keep investing some money into AT&T, but then AT&T goes bankrupt. If that happens, now all of this money that you put into it would disappear because this company just went down the drain. And now this wasn't your fault. It was the executives at AT&T that ran the company into the ground because you were just hoping to build this money printing machine. But the executives at AT&T didn't do a good job, so now you have to pay the price. So you got to understand that there is risk here. When you invest in individual stocks, you take on all the risk. So there are ways for you to mitigate that risk. Number one is by doing your research. If you want to invest in individual stocks, you have to keep up to date with the company. You have to read their earnings calls. You have to read their financial statements. You got to see how this company is doing. Because if you start looking at a company and you see the revenue starting to drop, you see the profit starting to drop, you see people not liking this company so much, then that's a red flag that you want to pay attention to. But if you don't want to really do all the work, then you shouldn't be investing in individual companies, individual stocks. Then what you want to be doing is investing in funds that give you exposure to dividend paying stocks, because there's something called ETFs, which stands for exchange traded funds, which give you exposure to a whole basket of stocks. So now instead of you trying to find the best companies to invest in, you can invest in an ETF, which gives you exposure to a whole bunch of dividend paying stocks. That way now, if one company goes bankrupt, you're okay. There's a whole bunch of other companies in there that are still paying you with cash flow, with dividends. So if one company goes down, you don't lose everything. So let's take a look at some ETFs. What you want to understand here is that not all ETFs are made equal. So when you're looking at ETFs, the way you do your research here is you can just research any ETF you want on Google, and it's going to pull up kind of like a fact sheet about the ETF, and it will tell you which stocks are in the ETF. So you want to kind of just get an idea of which companies are in there, because although you're not going to be doing the research on every single company and reading all the earnings statements, you want to kind of get an idea or a sense of what types of companies are in there. I'm not going to be going over how to actually invest your money in this video, so if you do want to learn more about how to do that and how stock market investing works, you can read our free PDF on stock market investing. It's a great guide that our team wrote that'll walk you through what stock market investing is, how it works, and how you can start successfully investing your money in the stock market. If you want to read that guide, it's completely free when you sign up for our newsletter, and I'll link it for you in the description below. So if you're looking for cash flow and you invest your money into SDIV, which is a high dividend ETF, then this right now at the time of recording this video is a 7.25% annual yield, which means you would have to invest right around $530,000 today in order to get this $40,000 a year passively. If you invest your money into VYM, which is a Vanguard ETF for dividend stocks, this pays right now at the time of recording this video a 3% yield, which means you would have to invest right around $1.3 million today in order to get the $40,000 a year. The same concept applies here to ETFs as it does stocks. This is not something where you're just gonna write a one-time check today. If you really want to do this the right way, this is where you're gonna want to have your money going into your investments every single month or every time you get paid. That way you can build this machine over time that is constantly paying you. And if you invest your money into a good machine, good stocks, good ETFs, then not only is your machine going to become more valuable, but your machine is going to be printing more money because the companies in your machine are making more profits, so they're paying out bigger dividends. A third very common way to invest your money for this passive cash flow dividends is by investing your money in REITs. A REIT is a real estate investment trust, and technically a REIT is a stock. But people look at stocks and REITs a little bit differently, just because stocks give you exposure to companies like McDonald's and AT&T and IBM. REITs give you exposure to real estate. So a real estate investment trust is a company that invests in real estate, and they kind of get their own kind of special classification within the stock market, because when you invest in a REIT, you are pretty much investing just for cash flow, because the way REITs work is they have a 90% rule, which says that REITs are required by law to pay out 90% of their profits to their shareholders, people like you, through dividends. And so REITs make money through rent, and they have to pay 90% of the profits out back to you through dividends. So REITs pay out a whole lot higher dividends, just because the whole point is to get this income through rent and then pay it out to you. The advantage for you to invest in REITs is you don't have to deal with all the headache of trying to find the right properties, dealing with contractors, dealing with tenants, dealing with property managers. You're just investing your money into the company that manages and owns the real estate. A couple examples of REIT ETFs that give you exposure to a basket full of different REITs. Again, I'm not telling you what to invest in, just examples are SCHH, this is the Schwab REIT ETF, and then VNQ, this is the Vanguard REIT ETF. When I say Schwab and Vanguard, these are just different companies that create and manage these ETFs. If you're not sure what I'm talking about, I already made a video where I explain what Vanguard is and what Vanguard funds are. That video will explain all of that. So if you want to watch that, I'll link that video for you in the description below. But SCHH right now at the time of recording this video is paying 2.8% a year, which means you'd have to pay right around $1.4 million today in order to get this $40,000 a year. And with VNQ, you would have to invest right around $1 million today in order to get this $40,000 a year passively. If your goal is purely just cash flow, at this point you might be thinking, all right, well, if I'm just trying to make as much cash flow as possible, I should be looking for funds and stocks that pay off the highest yields. And you might be thinking, okay, stocks are a little bit risky because I don't know or don't want to do all that research, then I'll just put my money into an ETF that's paying the highest yield. The thing that you want to pay attention to is that you never want to make an investment decision solely based off of this yield right here, because this yield can be deceiving. This yield is based off of the current share price, the current stock price that a stock is trading at. And so if a stock is tanking, then artificially a yield, a dividend yield can look so much higher because the stock price is down and the dividend might not have changed yet. And so you might buy into a stock or ETF thinking that you're getting this amazing yield, but what could happen is this ETF or this stock is on the verge of failure, which is why your yield looks so high. So you never want to look and make your decision just based off of what the yield is. That's one factor that you can pay attention to. But you really want to look at the underlying fundamentals. What companies are in the ETF? How strong are these companies? What sectors are they in? Are these strong companies that will be around in the future? Same with stocks. You're going to have to do a lot more research and kind of upkeep here, because if you're investing in one stock or a couple of stocks for the long term, you want to make sure that these stocks are continuing to perform and continuing to grow. With an ETF, you really just want to kind of get an idea of the company that is managing this ETF. Like Vanguard is one of the most reputable companies out there when it comes to ETFs, because they were like the pioneers of index funds. And so you just kind of got to get an understanding of who is managing your money or what companies are you investing in, because you want to make sure that this company or this fund that you're investing in is going to be around for a long time and it's going to continue to pay you for a long time in the future. Now, when you're investing for cash flow, you got to understand the drawbacks, because when you're investing in one of these companies, these are big established companies. And the reason why they're paying out a dividend to you is because they have so much money in their account that they don't know what to do with it. So the best use of this money is just to pay it out to you, the shareholder. You can compare that to a startup company, where this company, a startup company, might be using all of their money and more to grow as big as possible, as fast as possible. Like you might have heard that Uber was losing money for so many years. They were not profitable. Why? Because they were spending every penny that they had to grow quickly. And so not only were they spending all of their money, they were also losing money because they kept raising more money, getting into more debt. That way they can use this money to grow bigger. That way their company would become more valuable. So a company like Uber could see the stock price grow very quickly. I mean, they could see a 20%, a 50%, a 100% growth in revenue, and it really wouldn't be too surprising because they're a startup company and they're trying to grow very quickly. And so they're trying to see their stock price explode. You can compare that to something like McDonald's, where you're not going to see 100% growth in the revenue like that, because this company is not in that same ballpark. McDonald's is very big. They're very established. They're just trying to slowly keep growing their stores and keep growing their income slowly. That way they can just kind of maintain their dividends and maintain their growth. So this is where you kind of really got to understand what your goals are, because dividend companies are not going to give you that massive growth versus a startup company could. But at the flip side, a startup company also has more risk. A startup company could fail. It could go bankrupt. I mean, there's a lot of risks with investing in a startup company. With these companies, you have less risk. I mean, they can still fail. There's less risk, but you're not going to see the massive boom in the stock price that you could see with a startup company. I mean, over the long term, yes, you want to see the stock price go up, but your goal here is just that consistent cash flow. So you want to keep that in mind. The second thing that you want to make sure you understand are taxes, because now when you make this dividend income, it's taxable. The IRS is always going to want to get their cut when you make money. The way I want you to think of it is like a machine printing money. And the way that you can get more machines printing money is by using more money to buy more machines. So you have this one machine that's printing you money. And anytime it prints you money, you take this money and use it to buy another money printing machine. Now you have this machine printing you money, and when it makes you money, you use this money to buy another money printing machine. And now this money printing machine is also making you money. So now the first money printing machine is making you money, the second money printing machine is making you money, and you take all this cash and you use it to buy a third money printing machine, and on and on and on. This is what compounding is. And this is what they call DRIP, D-R-I-P, in a lot of stock brokerages, where you're now reinvesting your dividends automatically. The thing that you have to understand here is, yeah, you can take all of your dividends and reinvest it, which is good. It's a way for you to grow and accelerate your cash flow, because now not only are you putting more money into your investments every single month, but you're also using your profits from your investments every time you get paid to buy more shares. That way you're really just kind of building a big machine that's going to keep producing you more money year after year after year. But the thing that you have to remember here is, even if you don't take any of these dividends out and put them into your bank account or use them, you're still going to have to pay taxes on these dividends. So even if you reinvest all of your dividends, you're still going to have to pay taxes on the dividends that you received, even if you never use the dividends in your own personal account. Now, this is assuming that you're investing in dividends in your own personal account. If you're investing in dividend stocks through a 401k or an IRA or one of those tax deferred accounts, then you don't necessarily have to pay taxes on those dividends depending on what your account is. But if you're investing in your own personal account, then you're going to have to pay taxes on your dividends, even if you reinvest all of your dividends. Now, that's not a bad thing. I don't want you to stop investing your money or reinvesting your money because you're going to have to pay taxes on your profits. It's just something I want you to be aware of. So if your goal is to build up this machine that's paying you with cash flow, that way you can live off your dividend income, what you got to do is first figure out what you want to invest in, stocks or ETFs, or which kind of basket of stocks and ETFs. Second, anytime you get paid now, you're going to take a portion of your paycheck and automatically invest it into the stock or ETF that you want. Third, now when you get paid through your dividends, you want to reinvest these dividends back into your stock or ETFs. That way your dividends are building you more machines that are producing you more cash flow. Now, not only are you investing more money every single month, but your money that you're making is also going back into your machines to buy you more stocks and more ETFs. And fourth, you just got to remember that you're going to have to pay taxes on the dividends that you made, even if you don't get to put them in your own personal bank account today. If you do this, you're going to be building up a machine that's going to be building up your cash flow. And yeah, it's going to start small, but over time, you're going to start to see this dividend machine grow faster and faster and faster because you'll have more money going into your dividend accounts, and your dividend accounts are going to keep producing more money, which is going to go back into them, buying you more shares that are paying you with dividends. First things first, in case you're wondering, I was replacing the light bulb in my bathroom, and somehow as I was unscrewing the light bulb shattered and it slipped my finger, which is why I have a band-aid on, but everything's okay. We're back on YouTube, no delays there. I talked about the things that you need to do with your money as soon as you get paid, that way you have a proper financial system. If you haven't seen that video, I'll link that video for you in the description below. But in this video, I want to talk about the 7 things that you need to be using your money to buy, that way you can actually build wealth. This goes way beyond just having a budget and knowing how to spend your money. This is what you need to be buying and using your money for. That way you have the financial planning tools that you need. That way you can actually become wealthy. Money can't buy you happiness, but money can buy you a nice car. And money can buy you a nice home for your family. And money can buy your spouse a nice vacation. And money can buy you some extra guac. But before you can get the freedom that money can buy you, you need to know where your money needs to go before you put your money towards all of your wants. And we all know that guacamole is definitely a need. That's why in this video, I'm going to be going over the 7 places that your money needs to go, not including guacamole. That way you can build your wealth. But before we get into that, I need you to do me a quick favor and smash that thumbs up button below without cutting your finger. The first place your money needs to go is obviously your basic needs. This is your car, your house, your food, your water, your basic necessities that you need in order to survive. The thing that you really got to do here is you got to really draw a line to understand where your real needs are and where your wants start. My cousin's friend just graduated college and he got this new position in Phoenix. So he flew out to Phoenix, got this new job. The only problem was he needed a car to get to and from work, and he didn't have a lot of money to buy a new car. So he talks to my cousin about what he should do, and they talked about getting a used car. That way he didn't have to blow all of his money to get a new car or blow his future money on a new car. Anyways, so he's looking at used cars and he ends up going to the BMW dealership, calls up my cousin, and he says, "Guess what? I'm buying a new 4 Series." So now this guy, let's call him Bunty 2.0, needed a car. But instead of buying a car with cash that he could afford, that way he didn't have to worry about payments, he ended up going to the BMW dealership and he bought himself a 4 Series, where now he's going to be paying $500 to $600 a month for at least the next 3 years to lease out this car. So let's take a look at this. You need a car, and I think he put down $4,000 when he leased the BMW. And so you have a couple options. You can go out, put down $4,000 and lease a car, and now you're going to be paying right around $500 to $600 a month. Let's just say $500 a month. And this is now a payment scheme that you're starting. Once you lease a car, at the end of the lease, what are you going to do? Well, you're going to want to lease another car or buy another car, because at the end of the lease, all these car companies are going to tack on a whole bunch of fines and fees if you don't take another car from this company. So it's very unattractive to go out and buy a different car somewhere else or buy something that you can afford with cash. So when people start this payment scheme, they stay on this payment scheme forever. So now let's assume that now you're going to be paying this $500 a month every month for the next 30 years. After 30 years, what's going to happen? You're going to be left with nothing. Even if you own your car after 30 years, you're going to own a car that's really worth nothing because your cars aren't worth anything. But if you took this $4,000 and you bought yourself a used car with cash, a good working condition car. Now, you have this $4,000 car, you have no monthly payments. What you can do is instead take this $500 a month and invest it. And if you took this $500 a month and you invested it, and you could get a reasonable 7% annual return on your money. So you're just throwing your money in the stock market and you're hoping to get a little bit below average return. So we're not even talking about beating the market or even trying to meet the market. We're talking about a little bit below average. You just get a 7% return and you do this for the next 30 years. You're gonna have something like $600,000 in your account on the side just because you used this money to pay yourself instead of using this money to pay your car company. And so this is where you gotta decide what's your need versus what's your want. You need a car. You just want a BMW. Now, don't get me wrong here. I want you to drive a nice car. I love nice cars. I really like BMWs. But you gotta decide what your goal is right now. Are you trying to flex on Instagram or are you trying to become wealthy? Because these two things are going to give you two financially different results. If you're just trying to flex on Instagram, then sure, blow your money on a car. But if your goal is to become wealthy, then screw the car right now. Go invest this money into yourself and buy something beat up that is working. That way you have this money every single month that you can invest into yourself. That way you can build your wealth. Once you are ready, then go out and buy yourself whatever car you want because you can afford it without worrying about the price because now you're building that wealth or you've already built that wealth. This is where you got to really dig deep and figure out what do you really need and what do you just want. Because every dollar that you're spending on things that you don't need is a dollar that you cannot invest back in yourself. Now, you gotta understand here also, the goal is not to live small for the rest of your life. I don't want you to be the super frugal person who's just pinching pennies because at the end of the day, a penny saved is just a penny. I just want you to understand that right now, the easiest way to have some extra cash is just by not spending all of your cash. And so if you can understand how to live below your means, that way you have some extra cash, now you can put this money to work to help build you wealth. Now, again, I don't want you to just live small. I want you to work to grow the pie because there's a limit to how many pennies you can pinch and how small you can live, but there's no limit to how much money you can earn. But the first step to being able to build this wealth is you got to stop blowing all your money on things that you don't need. That way you have money to buy things that will actually build you wealth. The second place your money needs to go is towards your savings, but you got to make sure you're doing this the right way. Growing up, I was always told that if I wanted to become wealthy, the way you do that is by making a big salary and then you save as much money as possible. Turns out that's a big lie. You will never become wealthy by just saving your money. When you save your money is just sitting flat. It's not growing. While at the same time, the value of your savings and your dollars are losing value and being diluted because of inflation. That's why when we talk about saving money, you want to make sure you're saving your money the right way and the smart way, not the majority mindset way. For the majority of people, saving money is the path to freedom because when you save your money, now you have this big bank account, hopefully, that you can now use to go and buy things with. The only problem with that is if you could go out and save $100,000, you might feel rich, but $100,000 today is not going to buy you what $100,000 could 50 years ago. And $100,000 in 50 years will not be able to buy you what $100,000 can today. 50 years ago, if you had $100,000, you would be able to buy what $600,000 can buy you today. And in 50 years from now, $100,000, depending on what inflation is, might only be able to buy you half or a quarter of what $100,000 can buy you today. When I save my money, I'm only saving money for three things. I'm saving money for emergencies, I'm saving money for a big purchase, or I'm saving money for an investment. You gotta have a savings account with some cash in there because when an emergency happens, because that's life, you want to make sure you have cash to fall back on. That way when your car breaks down or your AC breaks, you don't got to go into debt to fix the problem. A good savings fund should have something like 3 to 12 months worth of expenses. So depending on what your risk tolerance is, that's where you kind of want to have the savings fund be. Second, you want to save for big purchases. If you want to buy a brand new car, or you want to buy yourself a new home and you need a down payment, or you want to buy a big TV, these things cost money and you got to save money in order to do that. You have to treat these two savings accounts differently because the last thing you want to do is use your emergency money to go out and buy a TV. Do not mix these accounts together because these need to be separate. And third, you should save your money for investments. I have a separate account where I have cash that I'm waiting to invest. I'm always looking for investment deals, whether it's on the stock market or whether it's real estate. And when I find a good opportunity, this is the cash that I use to go and buy it. I'm not using my emergency money. I want to use my investment money for that, which is why you want to keep this separate. And this brings me to number 3. The third place you need to invest your money is in your investments. Your investments are of things that are going to pay you for owning them, because now when you have some extra cash, there's a couple of things that you can do. You can go out, you can go shopping, buy yourself a brand new wardrobe, which isn't going to make you any money, or you can take this extra cash and you can invest it into a company or invest it into a property that is going to pay you for owning it. At the very bare minimum, you have to own some stocks or real estate. If you want to invest other places like crypto and forex and commodities, gold and silver, fine, but make sure you at least own some stocks and real estate. The whole idea behind investing your money in stocks is instead of you taking your money and going out shopping in the mall and spending all your money in stores, you're taking your money and you're buying a piece of the store company. That way, as stores make more money, so do you. It's essentially a way for you to stop being just a consumer and spending all your money to make everybody else rich, and for you to start being a producer. That way now, when companies make money, you're one of the people that's benefiting, because if the company makes more money, so do you. With real estate, it's a little bit different. With real estate, you own something physical and tangible, because when you invest your money in the stock, you just get a paper certificate saying that you own shares of a company, but if the company goes bust, then you own nothing. Real estate, on the other hand, when you buy a property, you own land, you own a building, you own bricks, you own windows, so you own something that you can see, feel, and touch, and it creates income, because if you buy a property, you can have a family living there, and they'll pay you rent every single month for living in your property. So now you own something real that you can see and feel, and you're creating income. And the whole hope is, if you're buying a property in a good area, the property value is going to go up, and so will your rents. So you're creating income and you own something physical and tangible. Stocks and real estate are both good investments. I have my money in both. I prefer real estate just because I like the income that I can create, and I like the idea of owning something real, but I also have money in the stock market. And so you got to really just figure out what your goals are and what helps you do that. The fourth place your money needs to go is asset protection, because as soon as people realize you have money, they're gonna try to take their hands and put it in your pocket and take some of your money and keep it for themselves. You don't want to let that happen, which is why you want to put up a shield, asset protection, to protect yourself and your family. Now, while I am an attorney, I'm not your attorney, so if you have specific legal questions, make sure you talk to a professional in your area. First thing you gotta do is you gotta have some estate planning. The whole idea behind this is, if you're building wealth, you're gonna have money, and when you die, you gotta know where this money is gonna go, because if you do not tell this money where to go, then your family is going to be fighting for who gets the money. If you want to avoid those fights, plan ahead, do some estate planning. There's a couple things you can do. You can get a will, you can get a trust. It's going to depend on what your financial situation is as to what is better for you. But the whole idea behind a will and a trust is you get to tell your money after you die where your money is going to go. If you don't do this type of estate planning when you're alive, then the government's going to come in and they're going to decide where your money should go. You never want the government to decide where your money should go. So do this type of estate planning, that way your family is not fighting for your money in the future. You also got to protect your assets by having insurance. Nobody likes paying for insurance, but insurance is a small price you pay today to protect you against a big headache in the future. This is going to be things like car insurance, health insurance, home insurance, life insurance. I know it's not fun to pay for all of these things, but if something bad were to happen to your car, your home, your health, your life, then your insurance company would come in and they would pay you or your family a big check, that way your family is at least financially okay. Things like car insurance, health insurance, home insurance are pretty obvious, because if your car burns down or if your house lights on fire, then the insurance company is going to come in and they're going to give you a check to go out and buy a new home or a new car. But life insurance isn't always straightforward. The whole idea behind life insurance is, if you die within your life insurance period, then your life insurance company will give your family a big check. That way, at least your family will be able to survive financially even if you're not there, because the last thing you want is for you to be the breadwinner for your family and then you're no longer there and your family cannot survive anymore without you. So they have to put up a GoFundMe page to raise money to pay for your funeral costs and to pay for your basic living costs. The good news about life insurance is it doesn't have to cost you a whole lot of money. Like if you're a healthy 30-year-old guy, you can get $1 million life insurance policy for less than $1 a day. I'm not going to go too deep into life insurance in this video because I've already talked about it on our YouTube channel, but if you do want to see how you can get a free life insurance quote, I got the link to how you can do it with our sponsor Policygenius in the description below. The fifth place your money needs to go is in your education, even if you think you're done with school. Growing up, I always thought that education meant school. Nowadays, for me, education means everything outside of the classroom. One of the easiest ways to fast track your financial success is just to keep learning, because the more you know, the more you can do. My education comes from 5 different places: books, classes, experts, experience, and mistakes. I'm not a big fan of actually reading books, but I go on a 5-mile walk, or I try to go on a 5-mile walk every morning, and this takes me about an hour and a half. And during my walk, I like to listen to audiobooks. I buy quite a few online classes. Some of them help me personally, and some of them help our business grow. You can learn from experts on YouTube or podcasts, or you can hire consultants. When it comes to learning from experience, one of the core values at Minority Mindset is fast is better than slow. And the whole idea behind that is, instead of spending all your time just thinking about what to do, go out and implement it and learn from whatever you're doing. And even if you make a mistake, which is the 5th way I learned, you can learn way more from your mistakes than you do your successes. I made a video on YouTube where I talked about my worst real estate deal ever. That was the only property I ever lost money on, but that money that I lost was really just like tuition into real estate investing, because I learned so much about investing in real estate from that one deal. Learn as much as you can by reading books, watching YouTube videos, and taking classes. That's good. But it's never going to replace experiential learning. You have to go out and you got to just put yourself out there, because you're always going to run over hurdles that other people have not, and you got to figure out how to overcome them. The 6th place your money's got to go is your health, and this isn't what most people think about when they think of health. If you've ever heard me talk about my quadruped triangle, I believe that there are 4 fitnesses in life, 4 places that you need to be fit if you want to live a happy and successful life. The bottom is physical fitness, then mental fitness, then spiritual fitness, and at the very top, it is financial fitness. If you want to invest in your health, you need to be investing in your physical health, your mental health, and your spiritual health. Everything else is about your financial health. Starting at the bottom with your physical health, invest in good food and a gym membership or some workout equipment. Look, I'm not a doctor, sorry mom and dad, but the best medicine is being proactive and taking care of your health. I know you're working hard to get that bonus and feed your family and go on that vacation, but you gotta take care of your body too, because this is the only one you got. Second is your mental health. If you are not happy, it does not matter how much money you have. It does not matter how successful you are. You will never be able to appreciate the things you accomplished. And so if you have this anxiety or depression and you are not happy, get it taken care of. Go into therapy, get some counseling, go into rehab. Whatever the cost is, pay it, because if you are not happy and you're not able to live with yourself, then it does not matter how successful you are, because your mind is going to be holding you back. So take care of your mental health, because that is going to be a pillar for the success of your whole life. And the third part of this is your spiritual health. And when I say spiritual health, I don't just mean religion. I mean, it could mean that, but it's really, what is your purpose? Do you really feel like you're on this earth to help underserved people? If it is, go out and give some of your money to charity, or go give some of your money to your purpose. Figure out what it is that's driving passion that wakes you up every single morning, and put some money into that, because if you do not feel fulfilled, if you do not feel like you have a purpose, then you're going to have no reason to get out of bed every single day. And the 7th place your money needs to go is to your family. Now when I say your family, I don't mean that when your cousin Bunty goes and blows his money at Gucci, that he goes and asks you for another $2,000 and you just give him this money. I mean taking care of your family. You know, when you're on your journey to build wealth, you're going to do whatever you can to invest every single penny you can, because you understand that this money invested is going to be able to make you a whole lot more money in the future. And as you do that, you're going to have to make sacrifices as a family. Maybe you don't get that nice car. Maybe you don't get that new home. Maybe you don't go on that vacation right now. But as you really start to build this financial foundation and this financial wealth, reward your family. Take your family and your kids on a nice vacation. Buy your spouse something nice because of what they put up with. I know it is hard building wealth. You got to make sacrifices. But as you start to see the success, don't just live frugal in the sense that you never enjoy your money for the rest of your life. Money only has value if you spend it, and support the people that supported you. So as you start to build your wealth, make sure you take care of your family too. The whole idea behind compound interest is you're going to invest some money today, this money is going to grow, and now you have your money working hard to make you money, and the money that your money made working hard to make you money. So it's almost like your money is having babies, and your money is just going to keep compounding and growing, which means you have more money working hard to make you money. Even if you're not investing your money in the traditional sense, you should hopefully still be earning this type of compound interest, because if you go to work every single day, you're compounding your knowledge and your skills. And so the longer you go to work, the more skills you're going to learn, and the more valuable you're going to be as an employee. That's why as you get older, your pay should hopefully go up too, because you're compounding your knowledge, you're compounding your skills, and now you're more valuable, which means you should be getting paid more money. It's the same concept with your money, except more money doesn't give you more skills, it just gives you more power. Like this $100 bill doesn't have more skills than this $20 bill does, it just has more power, because assuming that $1 will buy me a machine that's going to make me a nickel, now with this $100 bill, I can buy 100 of those machines. With this $20 bill, I can only buy 20 of those machines. So I'm going to be able to earn more nickels with this $100 bill than this, just because I got more power with this piece of paper than this one. But this is where compounding becomes so powerful, because every dollar I earn will buy me another machine that makes me a nickel, and I need 20 nickels to earn a dollar. This $20 bill will get me 20 nickels, which will buy me one more nickel making machine. This $100 bill will earn me 100 nickels, which will buy me 5 more nickel making machines. So I'll be able to earn more nickels with this just because I got more buying power. The more dollars you have, the more dollars your money is going to be able to make, and the longer you let your money sit there and invest and compound, the more your money is going to be able to grow. That's why Albert Einstein calls compound interest the 8th wonder of the world, because now your money is working hard to earn you more money, and every time your money does that, you're going to have more money that you can send out to work hard and earn you more money. So it becomes a system, almost like this machine that's just working to produce you more money, and anytime you produce more money, you can buy another machine that's going to be working to produce you more money. You don't need a ton of money to start, but the longer you have, the more your money is going to be able to grow, which is why you're going to see the biggest returns towards the end of your compounding. Like, even if you start with just 1 penny and you can double your money every single day, day 1 you have just a penny, and day 8 you have $1. By day 21, you have $10,000. Now your money is really starting to grow. And by day 30, you're going to have over $5 million, and you started with just a penny. Now, I already know what you're thinking. But Jaspreet, if it was so easy for me to double a penny, I'd already be doing that right now. Now, I know it's not easy to double your money every single day, and that's not the goal, but you can do this over time. There's a couple different strategies that you can follow to compound your money and really build your wealth over time. There's an active strategy and a passive way. I'm going to be going over this, but before I do, I need you to do me a quick favor and compound that thumbs up button below. Actively compounding your money is literally what the word says it is. You are being active, and you are buying something, selling it, and now you're using your profits to go buy something else. You see this all the time in real estate. You go out and you buy a $100,000 property, you renovate it, whatever, you fix it up, and you go sell this property for $150,000. Now, instead of going and buying another $100,000 property, you go out and you buy a $150,000 property and you renovate it, and now you sell it for $225,000. And so slowly you are growing your money and compounding your money because you can do bigger deals. Now you can do 2 deals at one time. You can do $200,000 deals and hopefully sell both of these for $150,000 each. And now you're just compounding what you're doing. You're slowly growing what you can do because you make some money and you take your profits and you reinvest it into whatever it is you're doing. This is exactly what I do on YouTube. Anytime somebody watches our videos on YouTube, I get paid. Thank you for your penny. Now, when I get this YouTube money, I can take all of it and go out and buy myself some new exotic cars, go get myself a new Gucci wardrobe, and go enjoy some fine dining at Chipotle with some extra guac. But what I actually do with this money is I reinvest this money back into our business. That way we can grow our business bigger. I'm reinvesting it back into our blog, I'm reinvesting it back into our newsletter, and I'm reinvesting it into an app that we're making. I'm actively working to compound this money by sacrificing some of these luxuries today that I could buy by reinvesting this money back into the business. That way I can grow the whole pie bigger. When I was in college, I started a cell phone accessory business with a friend of mine, and we didn't have a ton of money, and we wanted to start selling these like cell phone battery packs, and at the time we only bought like 10 of them because that's all we could afford. And so we bought 10 of these battery packs and we sold them, and then we took this money that we got and our profits and we went out and I think we bought 20 battery packs, and then we bought 50, and then we bought 100. And so it was like a slow compound where we took whatever money we had to buy these battery packs, we sold them, then we took this money and our profits and we compounded it, and that way we were able to buy more, sell more, buy more, sell more. And so you don't get to enjoy the profits when you're compounding it like this, because if you're taking all of your profits and reinvesting it, you're actively compounding it to grow the whole thing bigger. When you do this, the hope and the whole idea is you're gonna start off with something small, $100 or $1,000, and you're gonna grow it to something a little bit bigger. You're gonna turn $1,000 into $2,000. Now you're gonna reinvest the $2,000, turn it into $4,000, then the 4 to 8, the 8 to 16, and you're gonna slowly keep growing it. There is a risk though, because if you keep growing it and you don't take out any money for yourself, eventually there's a chance that things don't work out. And now you grew your $1,000 into $100,000 or $1 million, and then things fail, and if you didn't take out any money for yourself, now you're left with nothing. So if you're doing this type of active compounding, you really just gotta find the right risk balance for you, because anytime you pull a dollar out, that's a dollar that you cannot compound. But if you keep the dollars in there, then you take on more risk. I mean, this is one of the things that made Elon Musk so financially successful, because in the early stages of his career, when he would make $25 million, he would reinvest all of this money back into his business, and he would leave nothing for himself because he wanted to compound and grow his dreams and his wealth by taking every dollar he had and throwing it back into his beliefs. The second way you can compound your money is the passive way, and this is what a lot of people think about when they think of compound investing, because now what you're doing is you were taking your money and you're putting it into an investment, and you're going to let your money grow, and anytime your money makes money, you are going to reinvest that money back into it. That way this money that you have growing is going to keep growing even if you don't add money into the pot, because your money is growing and this new money is going to be working to make you money too. When I was in high school, anytime we talked about compounding or investing your money in my math class, the example that my teacher always gave me was investing your money in a CD in the bank or a savings account. So the way it works is you put your money in the bank, either in a CD or a bank account, and then your money is going to grow, and as your money sits there, it will compound and grow, because now this money that your money made will grow even more. But the interesting thing about this, so if we write bank account, you're not going to get a very good return, especially nowadays. A savings account nowadays is going to pay you like 0.1% if you're lucky, and a CD is going to pay you 1% if you're lucky. So if we look at this where you get a 1% return on your money, and I'm being very generous here, it is going to take you a long time for you to double your money. At this rate, keeping your money in the bank is going to take you 72 years to double your money. So you're not building wealth in this lifetime. Maybe your great grandkids will have some decent money to play with. If you're really looking to compound your money and grow your money, then you need to be putting your money in assets. So this would be things like the stock market. If you're investing in your money in the stock market, the goal is to grow your money by investing in companies that you believe in, because over time these companies are going to make more money, which will make the stock price more valuable for you. Now, if I come back here to active, if you do a business or flipping like we talked about, there's really no limit or kind of a baseline to how fast you can grow your money here. I mean, it's not super unreasonable to see 100% growth in a year, so it's really kind of uncertain as to how good of returns you'll see. It just depends on what it is you're doing and how good you are at it. So, there's really no baseline here. The stock market, on the other hand, has gone up by between 8 to 10% a year historically. So even if we stay on the low end here, 8%, you're going to be able to grow your money much faster. And the thing you got to understand about the stock market is there's a couple of different ways that you can make money. You can make money through appreciation, which is when the price of your stock goes up, and you can also make money through dividends, which is when the company that you invest in literally just gives you a cash check. So if you can grow your money by 8% a year in the stock market, you can double your money every 9 years. That's a whole lot better than 72. Now, if we kind of really look at compounding your money, this is where a lot of people assume that you have to invest in dividend-paying companies, which are companies that pay you cash payments. That way you can compound your money, because in that case, when you get this dividend, then you can reinvest this dividend back into the stock market and buy more shares. That way now your money is actually growing. So you invest in a dividend-paying company, this company gives you some cash, then your money automatically gets invested. That way you can own more shares, and now as you own more shares, you're going to get more dividends. As you get more dividends, you can buy more shares. So it creates this reoccurring cycle of growth and compounding. This dividend reinvestment strategy is a great way for you to build your own wealth, because now anytime you get paid, you're going to automatically reinvest this money. If you want to learn more about how to do that, our team broke this down in an amazing article on our website where it shows you, one, how to do this reinvestment, how to invest in companies, and how to find a good brokerage that does this. So if you want to learn more about how to do that, I'll link the article for you in the description below. But what I also want you to understand is that not every company pays a dividend. The only companies that really pay dividends are really more established and more mature companies, because these are companies that at the end of the year, they have so much cash in their bank account, they have no better use for their money, because if they could reinvest this money back into their company and grow their company bigger, then they would probably do that. But they have so much cash where they're just like, you know what, let's just start giving it away to our shareholders because we have no better use for this cash. And so people assume that the only way to compound their money is to invest in dividend-paying companies, because these are companies that are giving you cash, and when you get this cash, you can reinvest it. But you can also compound your money by investing in companies on the stock market that are reinvesting their profits. If you find more of a startup company that you really like and you really believe in and you think is a good value, and you invest in this company, and this company, anytime they make money, they don't give it away in dividends. They take this extra cash and they reinvest it back into their company, so they're really not making that big of profits. Like how Amazon during the early years of it being public never made any money, because anytime it made money, it reinvested it back into the company. If you invest in a company like this, then your money is still compounding, because you own shares of a company that's using all of its money to grow itself. And so while you're not getting this cash payment and accumulating more shares, your shares become more valuable because of this compounding, because the company that you're investing in is compounding all their money because they're taking all of their profits and reinvesting it. And there are pros and cons to both, because this type of investing, where you invest in more of a startup type company, has more risk because there's a chance that this company will fail, like we talked about here. If you're actively compounding your money, which is what this company is doing, there's a chance that it could fail. And so yeah, they're reinvesting all their profits and they're doing everything they can. But if this strategy fails, then there goes your investment. But on the flip side, with these dividend investments, because these dividend paying companies are typically larger and more mature, you're going to have a safer investment, which usually comes with a smaller return. So you might not see the stock price go up as fast, and your average dividend is typically somewhere in the 2 to 4% range. It really depends on the company, so it's not anything huge, and hopefully it will go up over time, but you just got to kind of understand where you want to be. It comes with lower returns here, higher potential returns here, but more risk. The second thing is with dividends, anytime you get paid a dividend, you have to pay taxes on this dividend. So while you take this dividend and you reinvest it, you still have to pay taxes on the money that you made, even though you don't actually get that money in your bank account because you're, in this case, reinvesting that money. Another way that you can compound your money is by investing your money in real estate. This is my actually favorite place to invest my money, because not only do you get passive income, if you do it right, you will also get the appreciation in the property. And so with real estate, when I invest my money, I'm looking for a 7% annual return on my money, cash on cash minimum. Ideally something closer to 8%, but 7% is my real minimum. Now the thing that you got to understand here is that if I get a 7% return on my money, it's going to take me 10 years to double my money. But in this case, the 7% is a cash on cash return that I'm getting every single year in my pocket. So if I buy a $100,000 property, that means every year I'm making at least $7,000 in profit. Hopefully over time this is going to go up if rent prices go up, but that means I'm making $7,000 a year. And now what I can do is, after 10 years, I will have this cash in the bank that I can use to go out and buy another property, or I can just take my own cash, go out and buy another property and supplement it with this money that I'm making from real estate. The reason that real estate becomes so attractive now on top of this is because not only are you getting this cash flow, but if you're buying your properties in a good area where people want to live, then you're also going to see the property value go up too. So I buy this $100,000 property, and every year I'm getting $7,000 a year in passive income, but over time this property might go up in value to, let's say, $200,000. And now if it comes time for me to sell this property, sell it for $200,000, I can do something called a 1031 exchange. It's a little loophole in the real estate world where now I can take all $200,000, pay $0 in taxes, and go out and buy a $200,000 property that's going to pay me with more passive income. And so when I try to do that in the stock market with dividends, the first thing I had to do was pay taxes on my dividends, and then I could reinvest these dividends. With real estate, if the property value goes up, now I can sell the property, pay no taxes today on those profits, and go out and buy myself a bigger property that's going to pay me with more money. Plus, even on the passive income, the cash flow that I'm making from real estate, this money that I'm getting here, there's a lot of tax breaks that I get with real estate that I don't get with the stock market. So even as I get the $7,000 a year in passive income, I don't have to pay taxes on all $7,000 because there's other tax deductions that I can take, like something called the depreciation tax deduction, which says that I get to get a deduction because my property is 1 year older. So happy birthday to your property, you get a tax break. So from a tax perspective, you get more benefits here from real estate, but real estate does come with its own downfalls because now you have to deal with more people. Like when you're investing in stocks, you're not dealing with anybody. You can go out and buy shares of Amazon or Lululemon or Chipotle and McDonald's and not have to deal with a single person. You can do this right off your phone. You want to go out and buy a real estate property, you got to have a real estate agent, you got to have a property manager, you got to deal with a contractor, you got to deal with an attorney, and you got to deal with tenants. And so if you don't want to be in that game, the stock market is better for you. Plus with real estate, you're in charge. You're the one that actually has to make sure that your property is generating income, and it's more work on your end because now you got to be the one that's negotiating the deal. And if your tenant doesn't pay, or if your tenant damages the property, that's a cost that you have to pay. And of course, the most obvious thing is that it takes a lot more cash to start investing in real estate than it does to start investing in the stock market. I mean, you can start investing in stocks with as little as $100, but if you want to go out and buy a property, you can't do that for $100, at least not a good property. Now, while it's your decision on where you want to invest your money, here, here, or here, the idea stays the same, that you need to compound your money. The whole idea behind that is anytime you make money, you want to reinvest at least some of it. That way your money is growing and the money your money made is growing. That way you can grow your money quicker and quicker and quicker over time, because the real secret to building wealth is investing. Yes, we talk about that all the time, but if you really want to grow your money quicker, you got to compound your money, which means you got to have more money in the fire that's burning to make you more money. But I guess if you're burning money, that's probably not what you want to be doing. So bad example, but you gotta have more money working to make you more money. Before we get into the next clip, I want to let you know that if you are interested in money management and investing, our team put together an amazing guide that you can download for free that walks you through how to manage your money the right way and how to invest your money and how you can build your wealth over the long term. So if you want to download this guide and start learning how you can be better with your money and how you can start investing for wealth, you can download this guide for free when you subscribe to our daily newsletter, and I got the link to how you can download this guide in the description below. There's a difference between wanting to become wealthy and actually wanting to become wealthy. Everybody says they want to be wealthy. I mean, who doesn't? Who doesn't want to have an extra $1 million? But if you want to actually be wealthy, then you gotta actually want to become wealthy and do the 5 things that I'm gonna be talking about in this video that we can actually become wealthy. You can really see the difference between somebody who wants to become wealthy and somebody who actually becomes wealthy by your actions. Like if you get a raise and you make an extra $1,000 a month, now what do you do? Well, if you just want to become wealthy and you're making this extra money, you're gonna say, ooh, well, let me celebrate a little bit right now and let me start investing later because I gotta enjoy my life right now. So you got this extra $1,000 a month and you have this plan where you wanna start investing and you wanna start building your wealth, but you kinda wanna enjoy this money right now because you only live once, right? And you're only young once. So what do? You buy yourself a nice car, you go on a nice vacation with your family, and you go to Chipotle and celebrate with some extra guac. But if you actually want to become wealthy, then what are you gonna do? You're gonna take all of this $1,000 that you're making extra and you're gonna put it towards your investments right now. That way you can achieve this wealth sooner because you understand that this is a short-term pain that you're going through. That way you can achieve that long-term financial freedom. The thing that everybody gets confused here is they assume that if you wanna become wealthy, you have to have a $100,000 a year job or $250,000 a year job or $1 million a year job. But it doesn't really work like that. There's a lot more to becoming wealthy than just having a big salary. I mean, it can help, but if you don't know how to use your money, or if you don't have the right mindset, or if you don't know how to pay yourself, or if you don't have the right patience, then it doesn't really mean anything. It's all about what's in here before you make the money. If you actually want to become wealthy, there are 5 things you need to do. Now, what you got to understand is that these 5 things are not easy. So if you're not willing to go through short-term pain, then it's not going to work for you. And if you are going to get caught up in your feelings and get triggered anytime something is hard or something goes wrong, then it's not going to work. But if you're willing to go through the short-term pain, and if you're willing to put in the sacrifice, and you follow these 5 things, then you will be able to become wealthy. The first thing you gotta do is have the right mindset about money. I bet you thought I was gonna say smash that thumbs up button below, didn't you? Having the right mindset is fitting because, you know, we are the minority mindset, which is all about having the mindset of thinking different than the majority of people. But when it comes to having the right mindset about money and building wealth, the first thing you gotta get right is understand the difference between becoming wealthy and being rich. Now, I know some of this is just syntax, but when people talk about being rich, a lot of times what they talk about is your appearance, the way you look. Having the nice cars, having the nice watches, having the nice home, that's looking rich. Being wealthy is more about being free, having the time to do whatever you want because you have the financial freedom. You can look rich and be broke. I mean, you can have a nice car, nice clothes, a nice home, go on nice vacations, but still be living paycheck to paycheck and have really no free time for yourself because you have to work your butt off in order to make the payments on all the things you have. Being wealthy is being able to live your life financially free without having to worry about the payments because you understand how to use your money, you understand how to invest your money, you understand how to grow your money, so you're able to live your life the way you want and have the time to do the things you want because you have that wealth. My goal is for you not just to have all the nice things. I mean, I want you to have the nice things that you want, but I want you to be able to afford the nice things without having to worry about the payments. That's why I want you to understand how to become wealthy. That way you can make those sacrifices today. That way you can buy all the nice things you want without worrying about the price. If you do want to learn more about the difference between being rich and being wealthy, I already made a video talking about that. So if you want to watch that, I will link it for you in the description below. The second thing when it comes to your mindset is if you want to become wealthy, you gotta stop hating the idea of becoming wealthy. I mean, we are living in this culture nowadays where it is just commonplace to hate people because they are wealthy. Why? Because they're wealthy. But if you really want to become wealthy yourself, instead of hating the person that has become wealthy, you need to be one of the people that is learning how they became wealthy. That way you can apply those strategies and techniques to your life. Hate it or love it, the reality is we live in a society where the producers are the ones who are rewarded and the consumers are the ones that pay the price. So if you really want to become wealthy, you got to understand this shift and you got to start being a producer. That way you're the one that's making money when everybody else is spending money. So if you really want to become wealthy, you got to understand that. And you got to stop hating people for becoming wealthy and understand the game and win at the game. Now, if you don't like the system, then what you should do is become wealthy and then use your wealth to give back and help other people. That's a good thing. And now you can inspire other people to do that. Okay, but if you really want to become wealthy, you got to have the right mindset, because if you hate the idea of becoming wealthy, you are never going to become wealthy. The reality of the game is the more money you have, the more you can do. If you're broke, you can sacrifice your time and you can help people. But if you have $1 million, now you can help out a whole lot of people. You can feed a lot of hungry people and you can shelter a lot of people who need shelter. If you're broke, you can't do that. Yes, you can sacrifice your time and you can serve people and you can help people, and you should. We should all have the mindset of wanting to give back and taking care of our community. That's very important. That's important to me too. But the more you have, the more you can do. So if you want to be able to help more people, you got to understand how wealth plays a part in that, because if you have the money and you have the resources, you can do a whole lot more good for yourself, your family, your community, and your surroundings. The third thing you got to understand about your mindset when it comes to money is that money is just a tool. Having money doesn't make you a good person, and it doesn't inherently make you a bad person. Having money just gives you money. Having money gives you the opportunity to send your kids to a better school. Having money gives you the opportunity to go on better vacations. Having money gives you the opportunity to buy better gifts for your spouse. Having money gives you the opportunity to feed more hungry people. Having money gives you the opportunity to drive a better car. Okay? Having money is a tool. It does not make you a better person. It does not make you a good person. It's just a tool, and you, as the owner and the holder of your money, get to decide how you get to spend that money. So you got to understand that money, it does not make you a good person. It doesn't make you a bad person. It just gives you money that you can use as a tool. And the last thing you got to understand about your mindset of money and wealth is you got to stop blaming luck for the reason why people become successful, because that's one big lie. Everybody says that, oh, this person became wealthy just because they had rich parents or because they got lucky or whatever. But the reality is that's just not true. I mean, Fidelity did a study where they looked at millionaires across the board, and what they found is that there was a portion of millionaires out there that inherited a big chunk of their wealth. But it wasn't everyone. I mean, it was only 12% of millionaires out there that inherited 10% or more of their wealth. So yeah, there is a factor of luck involved. But for 88% of millionaires out there, these are people that did not get this wealth inherited to them, or do not have rich parents. They did not grow up going to country clubs. They did not have a trust fund. These are people that created their millions themselves. Now, this is not to say that there's no luck involved in becoming successful or wealthy. There is some luck involved. But what you have to understand is that the majority of people who became wealthy, these are not people who were just given their money. These are people who worked hard and found a way to become wealthy. And what you find out is the harder you work, the luckier you become, because luck happens when hard work meets opportunity. And so the harder you work, the more prepared you will be, and the more ready you will be when the opportunities come your way. Are there some people who have the money just fall into their lap? Yes. Some people just win the genetic lottery, or some people just win the actual lottery, and some people just have the money given to them. But that's the exception to the rule. That's not the rule. The majority of people who become wealthy are people who created themselves by understanding the mindset and the 4 other things that I'm about to talk about. When you see somebody who has become wealthy, all you see is the tip of the iceberg. You see where they are now, you see the car that they're driving, and you see where they live. And it looks nice and it's easy to say that they became lucky, but what you don't see is all the sleepless nights, all the hard work that they went through, and all the kind of pain that they went through to get to where they are today. And so if you want to become lucky, you got to look a little bit deeper and look beyond just the tip of the iceberg and see what it really takes to get there. And you got to stop blaming other people for becoming wealthy and understand how you can do it yourself. The second thing you got to do is work on your income. So this is where things get a little bit tricky, because first we develop the mindset, and now once you got the mindset, you got to start earning money. Now there's a couple things you got to understand about your income. The first thing you got to understand is it's not just how much money you make, it's what you do with the money you make. But having more money can accelerate your path to becoming wealthy, and this is where you gotta make some hard decisions about yourself. If you're not happy with the amount of money that you're making, then you gotta do something about it. Look at yourself in the mirror and ask yourself, why are you not making the money that you deserve? Is it because you don't have enough skills, not enough degrees, or are you working a job where you're just getting underpaid? If you're not happy with the amount of money that you're making, you gotta stop complaining about it and you gotta start doing something about it. If you don't have the skills and you don't want to go back to school, or if you don't want to learn a new skill, then maybe you gotta take on a new job. Maybe you gotta learn a new side hustle. Maybe you gotta start a side business and do something to supplement your income. If you're just complaining about it and you're saying, man, I wish I made more money, I wish they would just raise my wages for doing nothing more except what you're doing right now, then you're just playing the emotional game and hoping that luck is gonna come through the door and put $1 million on your lap. If you're not happy with how much money you're making, ask yourself why and then do something about it. Depending on where you are and who you are, that might mean adding a second part-time job to your routine. And I know that's hard and it takes a lot of work, but I've been there. I went to law school full-time and I was running my business full-time, and I went to acting school in the evenings. It is long, it is hard, but it's a sacrifice that you gotta be willing to put in today if you wanna achieve more income. So you gotta know what you want, and if you're not getting what you want, ask yourself why, and then figure out what you gotta do to get the income that you want. The second thing that you gotta understand when it comes to your income is that there's a lot more to becoming wealthy than just how much money you make. I'm gonna talk about this in the third point, but having more income only does good if you know how to use the money that you're making. If you're just making more money to drive a better car, to live in a bigger home, you're just spreading yourself thinner, and now you have to work even harder to keep making all of your payments. So what you gotta understand about your income is there's a lot more to becoming wealthy than just making a lot of money. It's what you do with the money you make. There's a reason why so many high income people, so many high income doctors, so many high paid athletes, so many people who win the lottery still live broke, because they're living paycheck to paycheck. They're making a lot of money, but they're spending all the money that they make. So you gotta understand how an income plays a part in your life. Yes, having a big income can help you accelerate your path to wealth, but it can only do that if you're using your income the right way, and that's what I'm gonna talk about right now with number 3. You gotta pay yourself and stop spending all of your money. So Americans have an issue where when they make money, they feel like they deserve to spend this money and they deserve to have these nice things, because it's very hard for Americans to go through the short-term pain for the long-term freedom that you can get from not spending all of your money. I mean, it's just a strange culture that we live in where everybody feels like they need to have the newest iPhone, they feel like they need to have the newest laptop, they feel like they need to drive a brand new car, they feel like they need to live in a big home, they feel like they need to have all the newest things, and all these things keep costing you money, and now you look really good on Instagram and you have all these nice things, but you have no money left to pay yourself because you're playing in this game living off your feelings, where you spend money based off of what you think will feel good right now instead of what's good for your wallet long term. The vast majority of Americans are living paycheck to paycheck. Now, if you ask these people why, everybody will say it's because they're not making enough money. We say it's an income problem, but that's like the government talking. The government always says they're not making enough money, but we never look at how much money we're spending. There's also a spending issue. There's two sides to the coin. It's how much money you make, and it's what you do with the money you make. We can keep blaming us how much money you make, and sure, that might play a part in it, but that goes back to what I just said before. If you're not making enough money, why is it? Can you work a second job? Can you do something else? Can you learn a new skill? Can you make more money? Sure, that might play a factor, but on the second side of the coin is how are you spending your money? If you're living paycheck to paycheck and you drive a brand new car and you have AirPods and you have a brand new iPhone, then chances are there's more to this problem than just how much money you're making. You gotta look at what you're doing with the money you make. If you've been watching my videos, chances are you've heard me talk about guacamole a million times on our channel. Now, the reason I talk about it so much is because I love guac, and I have the money to afford an extra side of guac, no problem. But when I go to Chipotle, I never order an extra side of guac because it makes no sense for me to pay $3 for a small little extra side of guac when I can go to Kroger and pay $1 to get a whole avocado, and now I got 4 sides of guac for a fraction of the price. Yet people keep going to Chipotle and buying the extra guac. Now, I know what you're thinking. Oh, just Brit, a $3 side of guac is not the reason why people are living paycheck to paycheck. Yeah, I get that. A $3 side of guac is not the reason why you're broke, and spending $4 on a coffee is not the reason why you're broke, but it's not having the right mindset, because you're spending money on things that you should not be spending your money on right now, because right now what you need to be doing is paying yourself. Because if you're complaining about living paycheck to paycheck and not having enough money, yes, we can look at how much money you're making, and you should work on how much money you're making to work to increase that, but you also got to look at how you're spending your money. Are you spending your money on things that you don't need? Because that's the easiest way for you to have some more money left over to start paying yourself right now, is just by not spending all your money. If you look at things strictly financially, Do you know how rich people get rich and how wealthy people stay wealthy? It's pretty simple. They spend less money than they have. They live like they're broke. They don't spend every dollar that they make on nice cars and clothes and shoes. They spend some money on themselves. And when I say pay yourself, what I mean by that is you're saving some of your money for an emergency and you're investing some of your money. That way your money can grow and make you more money. If you are not paying yourself, if you're not spending some of your paycheck every month to go directly into your savings account, and if you're not having some of your paycheck go directly into your investments every single month, then you are not paying yourself and you are doing yourself a disservice, because all of your money is going out making everybody else around you rich, but it is leaving you broke. The issue is we live in this culture where we all live in our feelings. Like we feel like we worked really hard, so we deserve to reward ourselves by going on this really nice vacation, and we deserve to reward ourselves by buying this really nice car or buying this watch. Now these things are nice. I want you to have a nice vacation. I want you to have a nice car. I want you to have a nice watch. But I don't want you to sacrifice yourself from paying yourself, because then you're going to pay the price in the future. I want you to have these nice things, but I also want you to be able to afford it first. Let me let you in on a little secret. Nobody who's worth $1 million is flying on a private jet, unless you're one of those people on social media that's taking pictures on a private jet. That way you can sell more of your course on how to be rich by living your life and doing whatever it is you do. But nobody who's actually worth $1 million is flying in a private jet, because people who are actual millionaires understand what it took to become a millionaire, and they're not going to just blow all their money on something that's not going to help them keep their wealth and grow their wealth. You got to stop living this Instagram flex life where you're living life just to show off your income. What you got to do right now is live below your means and pay yourself first. That way you can use your money to build your wealth, use your money to build your savings. That way you can be free, and once you pay yourself, then you can live your life the way you want without worrying about the price. I probably should have put a trigger warning in the beginning of this video where if you're easily triggered, don't watch this video, but I did tell you that you got to step away from your feelings in order to really do these things. So let's move on to number 4. You got to stop the payments if you want to become wealthy. Now look, there's two types of perspectives when it comes to your payments and the way you live your life. On one side, you have the Dave Ramsey approach, which is the no debt, no financing, anything approach. Whenever you want to buy anything, you got to buy with cash, whether it's your investments or your liabilities. No matter what you want to buy, you got to buy it cash. On the other hand, you have Robert Kiyosaki, who is essentially like finance everything, never pay for cash for anything, and then use your money to buy investments and have your investments pay for all of your stuff. Both of these options can work. Obviously, one is less risky than the other, and one is harder to achieve than the other, because now you have to afford everything in cash. But what you really got to understand now is the difference between an asset and a liability, and when are you stretching yourself thin by financing something. Because when it comes to things that are not making you any money, you should not be financing it. Because when you're financing your clothes, now you're paying interest on something that is not making any money and something that is depreciating in value. So not only are you paying top dollar, you're paying interest on that, and this thing is just losing you money. Kind of like what I mentioned a minute ago, one of the easiest ways to keep more money for yourself is to stop having money leave your wallet. And one of the ways that you can do that is stop financing things and pay off the debts that you do have. That way you don't have money constantly leaving. I mean, you can think of it kind of like a cup, and at the bottom of a cup you have a hole. This hole is your payments. Now, the more debts that you have and the more payments that you have your car payment, you have your mortgage payment, you have the financing payments for your clothes, you have your furniture payments, you have your credit card payments. The more payments that you have, the more holes that you have. And now when you take your income, which in this case would be like a glass of water, and you pour it into the cup, the more holes that you have, the harder it is for the water, your money, to actually stay in this cup. So if you want to keep the money in the cup, what you got to do is you got to seal the bottom, and you got to stop having those payments. That way water can stay in your cup and it can start flowing upwards. That way now you have the money to create more income coming into your cup. So when I say stop the payments, that means 1, on all of your liabilities, the things that are not making you any money, your credit card payments, your car payments, these are things that you got to pay off quickly. That way you have less money leaving your account. 2nd, when it comes to buying more things, no more financing anything that does not pay you. And number 5 is you got to have patience, because you got to understand that building wealth is a marathon. It's not a sprint. This is not something that's going to happen overnight. And when you want it to happen overnight and you want it to happen quickly, you're more easily to get caught into one of those get-rich-quick schemes and falling into risky investments where now you're spending a whole bunch of money on things that are not making you any money, because when you jump into those get-rich-quick schemes, the only person you're making rich is the person selling that get-rich-quick system. Now, if you do want to accelerate your wealth, there's nothing wrong with that, but you just got to know how to do it the right way. On one hand, you got to work on earning more money. And now, as you're earning more money, you got to use more of your money to actually pay yourself. That means saving your money for emergencies and putting more money towards your investments. That way you have more money working to actually build your wealth. So if you want to do that, hey, great, work on earning more money, but understand that takes patience too. Building a business, building a side hustle, getting the raises, doing whatever you got to do to earn more money does take time. I mean, think of it like building a YouTube channel. You don't build a YouTube channel overnight. These are things that take time to build. You want to build a business, it takes time to build. These are things that take years. And so if you really want to become wealthy, you got to have the patience in your mind, and you got to understand that this is not something that's going to happen tomorrow. This is something that you're working on for your lifetime. That way you can live wealthy and live free. It's not something that's going to happen next week, next month, next year. This is something that we're building for the long term. And so you got to have the patience in order to build the wealth. If you enjoyed this video, here's a video on Vanguard ETFs that I think you love. And while you're at it, download our free stock market PDF. And as always, keep hustling. Instead of having this guy with a mustache manage your money, how about, and let me erase the mustache and the person, how about we just have a computer manage your investments, because computers are a whole lot cheaper to manage